Gold prices slipped today. A hawkish Fed, a firmer dollar, and hopes for a Russia-Ukraine peace deal weighed on gold. The more the Fed signals imminent rate hikes, the less attractive gold looks as an investment. Today, the Fed said it will wind down its balance sheet in June, which is sooner than expected, and this pushed gold lower. The dollar index hit a fresh two-decade high today. This makes gold more expensive for buyers using the U.S. currency, thus depressing demand. Gold also came under pressure from Russia and Ukraine. Both sides appear serious about ending the war through talks, and this raises hopes that the conflict could end soon. If true, this would be negative for gold since the precious metal tends to benefit from geopolitical uncertainty. On the technicals, gold broke below the support at 1950, which is the 200-day moving average. This level has been pivotal since February, when it contained gold's downside during the initial Russia-Ukraine conflict. With this level broken, gold could head towards the next support at 1880, which is the January low. In the short term, we remain bearish on gold. In our view, the market is underestimating the Fed's resolve to tame inflation. We think the Fed will hike rates by 50 basis points at each of its next 3 policy meetings. We also think the Fed will keep rates higher for longer than the market expects. Our U.S. team thinks there is a good chance of a 50 basis point hike in July, which is more than priced in by the market. We think the market is also underestimating the risk of a recession. In our view, monetary tightening will push the U.S. economy into recession by Q4 of this year. We think gold will struggle in such an environment. Gold usually does well when investors are unsure of the economic outlook because it is seen as a safe investment. But this time around, gold could disappoint. Investors have piled into the metal in recent years, pushing its price up by over 200. This rally has made gold very sensitive to changes in interest rates. When rates go up, gold prices usually fall. And this is because gold does not offer any yield, and an increase in rates makes other investments like bonds more attractive. Having said that, gold is still far from its all-time high of nearly 20,000 hit in August 2020. Back then, investors were worried about de-dollarization, central bank digital currencies, and the U.S. election. Gold was also benefiting from massive stimulus measures. There's little of that left. Central banks are now tightening policy, and this is hurting gold. For these reasons, we remain bearish on gold in the short term. The precious metal is highly sensitive to U.S. monetary policy, and with the Fed set to hike rates in the coming months, gold could come under further pressure. Geopolitical risks are also receding. Conflicts rarely boost gold prices in the long run. Eventually, investors look beyond the precious metal as a safe investment.